Right. So it is Wednesday, January 28th, 2026. And if you've glanced at your portfolio or, even just the headlines this morning, you have probably seen a lot of flashing red lights around Starbucks.
Oh, yeah.
They just dropped their Q1 earnings for fiscal 2026. And if you only look at the bottom line, it looks like a disaster scene. Profits have just evaporated.
It is definitely one of those reports that makes you do a double take.
Yeah.
You see the earnings per share down 62%. The tax rate is hitting numbers that, shouldn't even be possible for a corporation. And you think, is the business imploding?
But then, and this is why we're doing this deep dive, you look at the top line, you look at the actual coffee shops, and people are back. For the first time in 2 years, the lines are actually getting longer because more humans are buying coffee. So we have this huge disconnect. The business seems healthier than it's been in years, but the bank account looks terrible.
That is the paradox we have to solve today. This is the first real stress test of CEO Brian Niccol's back to Starbucks strategy. We have to figure out if the financial pain we're seeing, and it is significant, is just the cost of fixing the foundation, or if something is, structurally broken here.
Let's start with the good news because I think it really contextualizes all the bad news.
Agreed.
For 8 quarters, that's 2 full years, Starbucks could not get more people to walk into their U.S. stores. Every single time they reported growth, it was because they just raised prices.
Which is such a fragile way to grow. We talk about this all the time. If your growth is entirely dependent on pricing power, you eventually hit a ceiling where the customer just says no.
And that's where they were stuck.
Exactly. They were masking an erosion of relevance with price hikes.
But today's report just flips that whole script. Global revenues are up 6% to nearly $10 billion. But the number that really matters is that North American comparable store sales figure.
The comp number.
It's up 4%.
Yeah.
And we know that 4% isn't just inflation this time.
No. And that is the critical shift. That 4% is made up of a 3% increase in transactions and only a 1% increase in ticket or price. For anyone who follows this closely, that transaction number is the holy grail.
Right.
It means the Back to Starbucks initiative, which is basically this huge operational overhaul, is actually resonating. It's changing human behavior.
Let's dig into that Back to Starbucks idea for just a second. It always sounds a bit like marketing fluff, but Niccol has been, ruthless about this.
He has.
It's about staffing levels, it's about speed, and frankly, it's about the vibe.
Yeah.
Making the cafe feel like a cafe again and not, a factory for mobile orders.
And you can see the direct line from that strategy to these numbers. To get transaction growth in a mature market like the U.S., you have to steal market share, or you have to increase frequency.
You can't just launch a new syrup flavor.
Exactly. You do it by making sure that when someone walks in at 8 a.m., they get their drink in 3 minutes and the barista isn't completely stressed out. That 3% transaction growth tells me the operations are stabilizing.
Yeah.
The throughput is actually working.
CEO Brian Niccol is certainly taking a victory lap on that specific metric. He's quoted in the release saying they're ahead of schedule and that this momentum is just the beginning. It feels like he's trying to tell the market, look at the busy stores, please ignore the messy spreadsheet.
And honestly, he's earned a bit of leeway there. Reversing a 2-year trend of declining traffic, especially in this economy, is incredibly difficult. If that transaction count was still negative today, I think the conversation about his tenure would be taking a very dark turn. But it's not. Customers are voting with their feet.
Okay, so customers are voting with their feet, but it looks like the accountants are voting with a sledgehammer.
Right.
We have to talk about this profitability squeeze. While revenue is up, the operating margin has contracted big time. It dropped 290 basis points to 9%.
That is a painful drop. You rarely see a blue chip company lose almost 3% of its operating margin in a quarter without some kind of major crisis.
So if the stores are busier, why are they making less money on every single cup?
It's basically a 3-front war on their margins right now. The first one is internal labor.
Okay.
We just talked about the customer experience getting better. Well, that's expensive. Part of the Back to Starbucks plan involved putting more people behind the counter and paying them enough to actually stick around.
So that's a strategic choice. They're basically trading margin for volume.
Correct. It's a bet. They're betting that spending that money now secures the customer's lifetime value down the road. It's an investment that's just classified as an expense.
Okay, but what are the other 2 fronts?
They're external, and they are much nastier. First, you have the coffee beans themselves. Commodity pricing is just elevated across the board.
And the report specifically calls out the third one, tariffs.
Yes, and this is where the bigger macroeconomic picture gets a little gloomy. We're seeing the impact of trade barriers hitting the P&L directly. They don't break down which tariffs are biting the hardest. Is it equipment, steel for new stores, agricultural imports? But when a company like Starbucks lists tariffs right alongside labor,
That's a huge deal.
it signals a real shift in the global cost of doing business.
So it effectively raises the floor on all their costs. You have a situation where they're paying more for the coffee, they're paying the government more to move materials, and they're paying the staff more to serve it.
Which explains why the GAAP earnings per share is only 26 cents, down 62% from last year. That's the cost of doing business in 2026. But we are sort of dancing around the biggest crater in this whole earnings report.
The tax rate.
The tax rate.
I honestly thought it was a typo when I first read it. The effective tax rate for the quarter was 61.7%.
It looks like a typo.
A normal corporate tax is, what, 21%? Maybe 25% on a bad day? How do you end up paying nearly 62% of your income to the tax man?
And this brings us to the most significant piece of strategic news in this entire deep dive. The China pivot. That tax rate is the mathematical debris from a massive explosion in their business model.
So this is the joint venture with Boyu Capital.
Right. For decades, the Starbucks story was all about global conquest. They owned their stores. They wanted full control, especially in China, which was supposed to be their second huge engine of growth.
And they built thousands of company-operated stores there.
And now, they're selling a 60% stake of that entire business to Boyu Capital.
Wow.
They are essentially admitting that the go-it-alone strategy has hit a wall. Boyu Capital is a major private equity firm there with deep connections, deep operational expertise. By selling 60%, Starbucks is moving to more of a franchise model. They keep 40%, they collect royalties, but they offload the risk and the daily grind to a local partner.
Okay, strategically, I get that. It lowers your exposure to geopolitical tension, local competition, all that. But how does selling a business trigger a 61% tax rate?
It comes down to something called indefinite reinvestment assertions.
That sounds like something a lawyer charges you $1,000 an hour just to explain.
And it's worth every penny to the IRS, I'm sure. But here's the simple version. For years, Starbucks made money in China and just left the cash there. They told the U.S. auditors, we aren't bringing this money home, we're going to reinvest it in China forever. Because of that assertion, they didn't have to accrue certain U.S. taxes on it.
But the moment they signed the deal with Boyu.
The moment they decided to sell, that assertion fell apart. You can't say you're reinvesting forever if you're cashing out. So accounting rules force them to recognize the tax liability on all those past earnings, all at once, in one quarter.
So that 61.7% isn't what they'll pay next quarter. It's a one-time clearing of the decks.
Exactly. It's an accounting true-up. It makes the quarter look absolutely horrific, but it does not mean their ongoing tax burden is 60%. It does, however, signal a massive decoupling. They are cleaning up the books because they are fundamentally changing their relationship with their second largest market.
Is it fair to call this a retreat?
I'd call it a localization. Look, the Chinese market has become incredibly fierce. Local competitors are so aggressive on price and on tech. A Seattle-based board might not be agile enough to win a price war in Shanghai. Boyu Capital can be. But yes, it's a retreat from the empire-building phase of Starbucks.
Yeah.
They're acknowledging they can't dominate alone anymore.
What's so fascinating is that despite all this corporate restructuring, with a for-sale sign basically hanging in the window, the Chinese stores actually did really well this quarter.
They did. China comp sales were up 7%, with transactions up 5%. So the brand still has heat. The consumer isn't leaving Starbucks China. Starbucks corporate is just changing how they own that consumer.
It creates this really weird duality in the report.
It does.
You have this held-for-sale classification on the assets, which stops depreciation. So on one page, they're saving money because they're not writing down the espresso machines in Beijing. But on the other page, they're getting hammered by the tax bill for the exact same deal.
It makes the financial statements incredibly messy. That's why you see the international segment's operating margin actually expanding to 13.7%. That's not because they got super efficient overnight. It's largely because they stopped counting depreciation on those assets they're about to sell.
So, okay, we've got the U.S. turnaround, we've got the China sale. Let's look at the grocery store aisle, the channel development segment.
Right.
This is usually the boring, steady part of the business. The bagged coffee, the K-cups, those frappuccinos in the glass bottles.
The revenue was up huge there, 20% growth to over $500 million. The Global Coffee Alliance they have with Nestlé is pushing a lot of product. And the ready-to-drink market is still growing.
But I noticed that margin squeeze followed them here too.
It did. And that, to me, is a little worrying. Operating margin in channel development dropped to 41.3%.
41% is still a fantastic margin.
Oh, it's a great margin, but it used to be almost 48%.
That's a steep drop for a packaged goods business.
The report blames mix shift. So maybe people are buying lower margin products, but also product costs. This just reinforces that inflation narrative. It's not just expensive to run a cafe, it's getting more expensive to manufacture and ship a bottle of cold brew. If that 41% margin keeps sliding, one of their most reliable profit engines starts to sputter.
Taking all of this into account, the tax hit, the labor investments, the China sale, what is leadership telling us to expect for the rest of 2026?
They're holding the line, which I think is pretty bold. They reiterated their full-year guidance. They're targeting global comp sales growth of 3% or greater.
So they really believe this quarter wasn't just a fluke.
They are betting their jobs on it. They also expect earnings to normalize, to get back between $2.15 and $2.40 per share once all this tax noise clears. And despite everything, they are still opening stores. 600 to 650 net new locations globally this year.
And they're bringing in new blood to help. We saw the appointment of Anand Varadarjan as the new CTO.
Which is a critical role. If you're going to run this high-throughput transaction model, your app cannot crash. Your personalization engine needs to work. He has a massive task ahead of him to make sure the tech stack can support this new volume.
And for any income investors listening, the dividend streak is alive.
63 consecutive quarters. That's the security blanket in this whole report. They declared 62 cents per share. It's a reminder that even when your earnings plummet 62% on paper, the cash flow of this company is still strong enough to keep paying shareholders.
The CFO, Kathy Smith, she used the phrase clear line of sight when talking about sustainable earnings growth. It feels like she's trying to calm the nerves on Wall Street ahead of the investor day tomorrow.
Clear line of sight is code for the worst is over. She's signaling that the tax hit is a one-off, the labor investments are now baked into the run rate, and moving forward, the leverage will kick in. It's a confidence game right now.
So let's synthesize all this for you, the listener. We have a company that is radically changing its shape.
I think of it as a renovation. They are stripping the business down to the studs. They're fixing the labor model in the U.S. to get customers back, which is expensive, but it's working. And they are structurally offloading the risk of their China operations to a partner, which caused a massive one-time tax bill, but cleans up their portfolio for the future.
So that headline, profits down 62%, is technically true, but emotionally it's pretty misleading.
Completely misleading. If you're a long-term observer of this company, you should care way more about that 3% transaction growth than the 62% earnings drop. You can fix a tax bill. You can't fix a brand that people have stopped visiting. The fact that they fixed the visitation problem is the real story here.
That's a great way to frame it. But I want to end on something that's been nagging me about this whole China deal. We're seeing a trend here, right? You have McDonald's, you have KFC, and now Starbucks, all these icons of American capitalism, moving to this franchise or JV model in China.
It's the end of an era. The era of the sort of imperial American brand just planting its flag and running the whole show is over.
Exactly. And it forces us to ask a really difficult question about the future of global business. If Starbucks in China is majority owned by Boyu Capital, run by local management, using a supply chain optimized for that region, is it still Starbucks?
That is the existential risk.
Yeah.
As you localize to survive, do you dilute the very thing that made you special in the first place? The Starbucks experience was an export of American coffee culture.
Right.
If you hand the keys to a Beijing private equity firm, you might win the market, but you might lose the soul of the brand in the process.
And if that model works there, do they start doing it elsewhere? Do we see a fragmented Starbucks where the logo is the same, but the company is just a collection of local fiefdoms?
It's a distinct possibility. We might be watching Starbucks transform from a global operator into a global licensor.
Something to mull over while you wait in line, which apparently is getting longer again. Thanks for diving deep with us.
See you next time.